Ah. All right, all right. Welcome, everybody. Get this thing recording as well. All right. Again, guys, good to be with you tonight. We're gonna get this thing started right away. All right, we got navigating the territory. Understanding business culture for your trucking company. And guys, welcome tonight. It's great to be with you again on a Monday night, May 15th. This is me, Cheston Bulgin, Bulgin Consultant, and this is how you reach us. 888-4BTB now. And you can always reach out to me directly via email at cheston@bodybuildsconsultants.com. Before we get started, let's do this disclaimer real quick. The following is for educational purposes only and is not to be considered financial, accounting, or legal advice. Please consult your tax, accounting, and legal professional for specific advice. And as always, we're looking to bring relevant conversations to this week's session, or every Monday night, we want to bring some relevant topics to you. So if you want to talk about something specifically related to what we share here, you can always reach out to me via email, via Instagram, or LinkedIn. All right, so here is my promise to you every single week now. Now, you're going to gain at least one thing that will help you to survive and thrive in trucking. You will also have a new level of clarity on what to do, the next actions to take inside of your business that will make the most impact in your business. A lot of what we talk about here tonight, guys, is inside of the financial aspect of the business, like what to look for, how to read the number story. For us, for me, rather, it's very important to really understand from a numbers perspective what it is that we're doing. And I believe wholeheartedly that if you have this in mind, like just understanding like what the numbers mean for your business, if you're actually tracking this, it will make the difference for you as well. In any market condition, it doesn't matter. It'll help you see what's coming. It'll help you identify patterns to be able to get ahead of the game if we're there to focus on these things. And just to recap, running it by the books. This is a constant dance with reality. All right. It means that we have intention, like an intended future we're creating. And there's also a reality of where you are right now in business. And this is a constant bridging of those gaps between where we are and where we want to be. Last week, we started talking about some uncertainty. We're going to continue on the conversation that we started last week, specifically about what to do in terms of tracking everything. Like what it is that we need to track, what does it really look like, get really clear on what is the reality of what business owners in general do with tracking and recording things, especially small business owners. And we're going to bring it back home because it's so critical and important inside of what we do here in the trucking industry, to have these systems in place to be very clear. Okay. Last we talked about just being efficient inside of business, like really running your company like a well-oiled machine. So we had that. If you actually were not here last week or did not chime in last week for the talk that we did, you can always visit our group. You can actually get into our group. It's a business mastery group on Facebook. We call it 10-figure business mastery in Facebook. You can always see it there for the recording. And Teresa, what I'll do also is I'll make sure that these recordings that we're doing from now on, that you have access to them. I'll send them over to you so that you can always upload them where you finish for the group.
Sounds good.
Good. So we did get into somewhat of the numbers game, talked about gross profit, what that is, what that looks like. And we got a couple of examples inside of that. And we did a quick example to begin last week, talking about what gross profit really looks like. What gross profit really means the money that I bring in overall, that's like the total revenue, total sales, like what did I actually bring in? And then it takes into account what it costs me directly to produce that. So if I did not have to produce that income, I would not have these costs. But since I went out there to produce this income, this is how much it cost me to produce it. Now, in this example, we can see clearly what the number is. If I do a job, in this case, if I pull a load and I pull this load for $5,000, and it costs me $3,000 to produce that, then the gross profit on that is $2,000. Ideally, we want this number to be as high as possible. Okay, we want it to be as high as possible. Reason being is that we have a gross profit margin of 40%. Now that 40% needs to be, well, in this example rather, it needs to be enough to cover all of the other overhead costs, and then leave you with a profit after that. All right. So if we're not really honed in, if we're not dialed in on this, then we could actually be misled in thinking that we have more money than what we do, which is the case a lot of times. We see like, well, we just brought in, 20,000 this week, but you don't realize that you spent about 18 this week going out by producing that 20,000, and then all the other costs associated with it. All right, so we're talking about planning for profitability, okay? And a lot of the things that we take into consideration when we look at planning, we had a good comment last week about, what do I do if I'm starting a trucking company? What kind of things do I look out for if I'm not too certain? And as an entrepreneur, man, there is a little bit of leaping in faith when it comes to things. Actually, like not just in the beginning, but always. There's a certain amount of faith that we want to have when we're operating out here. It doesn't have to be blind faith, trusting like what the trends are inside of what you have been doing and what the market overall has been doing in the industry. We take into account these variable costs versus fixed costs, and really that's the same thing we talked about. Those variable costs are the costs associated with producing the revenue. Fixed costs are the costs associated with overhead costs that would come no matter what. And then we have other considerations for that land and equipment, like what's going to bring more for bang for your buck. And then we have volatility, which is a little bit of uncertainty. Now, even though I'll say this too, like volatility, how many of you guys get a certain feeling, like a negative feeling in your gut when you hear about volatility? Anybody? Like raise your virtual hand if you have this feeling in your gut when you hear the term volatility, volatile. Everybody's good with volatility. Okay, Chris, yeah, so yeah, you get a little stress feeling inside. Like we call this cortisol, stress hormone pops up when we hear certain things. And volatility for a lot of people, it means that. And for others, it does not. For the ones that it does not mean, like it doesn't cause that stress, it actually causes the other things like a dopamine spike. It's like an opportunity, like I'm actually gonna get something that I want out of it. Right? And there's opportunity in volatility to understand like trends of everything. Like volatility just means that there's fluctuation, right? Things don't occur to be as stable as what they can be. Right? And a lot of times we go through life and we want things to be stable, and that's just not how it is. Everything is transitory. Even if you're sitting down, even the thing you're sitting down on, it's a chair or sofa, that's not really stable if you look at it on a microscopic level. It's moving, right? But it moves in a way to cause it to be reliable enough for you to sit on. I just said something that's deep, right? If you think about it. Now, if you look at it on a larger scale in terms of economics and finance, volatility is not necessarily a thing to be stressed about if we go into it and understand what we're dealing with. Like we're looking at the patterns of life. Okay, there's always a pattern of things. There's always a pattern of things. The skill set is in being able to identify what pattern this is and get on it, just like a surfer understands the pattern of the waves on an ocean. You can actually understand the pattern of the business and be ready at all times to take advantage of whatever pattern may show up. Okay, and it may occur as uncertain, but there are some things that we actually do know, even though it occurs as uncertain. to reinforce some of these concepts with you guys. And before I move on, I just said a few things there. Does anybody want to comment about what I just said? That was like not something that normal people would just say. I just said that the thing you're sitting on is not stable. Well, it's stable, but it's volatile to some degree. But we should know the patterns of things. Anybody? Comment? You guys are good with that comment? That was kind of controversial, confronting. Anyway, does anybody have anything to say about it? Yeah, constant volatility equals stability. Yeah. Relatively, yeah, right, I see you. Not necessarily constant volatility equals stability, but just understanding the patterns of life. There's always something to look at. You say, okay, this is where things, high probability wise, make sense. Okay. And the skill is inside of being able to identify where those patterns do make sense, and you can make your choices from there. Now, the issue is when we don't take the time to read patterns. If we don't take the time to read patterns, we don't develop a skill set patterns, and then life becomes a mystery. The business becomes a mystery, and it's always outside circumstances and reasons and the economy and whatever else is going to be the cause of the downfall of business. I couldn't succeed because of this, is what we say. It's when we take ownership of the skill sets and understand how things work, is when we can actually put one foot in front of the other and say, I'm gonna own my future because I understand exactly what's happening here, choice by choice by choice. And part of that is understanding the financial picture and understanding how to read the numbers. Variable cost. The more I produce, the higher the cost. That's a variable cost. The more I do something, the higher volume I do it, and it's going to be, proportionally, that cost is going to go up. So if it costs me $1.20 to produce a load, produce a mile on a load. The more miles I do, the more it's going to cost me. If it's a fixed cost, these are costs that I've agreed to pay in my business, no matter what I do. They're always going to be there. Insurance costs are always going to be there. Whether you decide to spin the wheels on the truck, or if those wheels stay fixed, those costs are still going to come. Whether it's rental, whether it's the lease payment or financing on the truck, these things are always going to come, no matter what, regardless of production or activity. Some examples, again, you have fuel. These are variable costs: fuel, driver costs, maintenance costs, factory commissions, dispatch fees. All those are variable costs. You don't pay these unless you take on loads. Examples of fixed costs: insurance, truck leases, payment, rent, salaries, office expenses like your software apps, maintenance, utilities, highway use tax, registration, franchise tax, corporate renewals. All those things are fixed. You're going to pay those no matter what. So again, we're looking at profit margins. So gross profit and gross profit margin are things that we want to take a look at to make sure that those numbers deliver enough to cover our fixed costs, and then leave us with a profit afterward, which would be our net profit, net profit margin. Okay. All right, so we talked about planning for profitability. We looked at some trends, and we talked about this last week. This is what we had last year. And we looked at what it's doing right now, currently in the fuel prices, the diesel prices. All right, we're right at $4 per gallon. And we did a little bit of a discussion about what to research and what to analyze last week. And certain things we want to look at is like what the spot market is doing. We also said that it's not really the best idea to continue to do business in the spot market. It's not good. Always run your business by the load boards, by the brokers. Right? There's not much there's not much stability inside of that, right? So we want to actually have a goal to, once we get started in this industry, we want to transition to be able to have contracts that guarantee us a certain amount base when we actually do lanes. Okay. Couple of insights on where to get information. If you want to research the industry, like what these things, like what are these trends inside the industry, there's the United States Energy Information Administration. Gives you the lowdown on what the energy prices are. Energy talking about, yeah, I'll talk about that, Ron. Just give me a second, I'll come back to that. So the United States Energy Information Administration is a website you can go to. It'll tell you what like the gas prices are, diesel prices are, what they have been historically. We can look at these things and see what the trend has been over time. We can look at it, we can look at what it's doing right now. And then we can get on the data freight analytics site and we can tell us what the spot market rates are. This is good. You ask that question. So spot market is basically what I can go on a load board and see what it's paying for a particular lane. This fluctuates. Just like any market, like free market, it fluctuates from at any point in time. The rates were higher toward the beginning of 2022 than they are now. Right, they've consistently come down, like in the spot market, which is like what you can go on a load board and get for flatbed lanes or drive-in lanes, right? So these prices are not fixed in time. They actually move up and down. This is what we call volatility, right? So if we understand what we're dealing with, if we know the patterns of things, we can anticipate and make moves and decisions based on what the trends are. For example, I know fuel is most likely going to go up right now. Like at the point there where it is, it's at a low. $4 a gallon for diesel. It is most likely high probability going to go up from here, back up towards $5, average on the nation. So I can plan for that. Like, why would I bring down why would I continue to pay higher wages to drivers when I know that eventually my costs are going to be eaten into by fuel? Why would I operate my company based on my fuel costs being $4 when I know it's going to go up? I'd always look to have, decisions made on certain set goals in my company for load planning. My margins, if I want them to be at 60%, I'm going to shoot for loads that are going to give me a 60% margin based off where fuel is headed, not what fuel is. Just like if I'm in a football game and I'm quarterback, I'm not throwing to where the receiver is. I'm throwing where he's going to be. So it should be my planning, right? And I know I'm talking about some things here, and like, how do I know these points in time? But if you understand, like, if we look back at this other chart here, this was a breakout point. You see, like this trajectory over here, like it broke out above $4 at a breakout point. If we look at it closer, there's more activity even in this little upward movement. There's more decisive activity that we can see in the previous slide. It actually zooms in and shows us what was really happening during that time period. This stuff was happening during that time period. It was going back and forth. This is what we call volatility, like up, down, up, down, up, down, and then up. But this was a breakthrough point, right? Before it had not been this high. It actually rejected getting this high the first time it tried to reach this level of pricing. But usually when things like go above, they'll come back down and they'll use this as the new low, right? What before was the high will now become the low. You can see it happen here. This before, You see, it had like never really broke above $2 here. But once it broke above $2, it came back down to test it a few times. It was a low after that. It is the pattern of life. It never went back down below 2. It attempted here, and I gave a semi-attempt here, but it never really went back down below $2. And then, boom, all the way up above the last high, like what it did here. So in the future, here's what I can expect. Here's what I can bet on. You know, that is going to stay above $4. And $4 is most likely going to be the new low. You guys, does that make sense, guys? What I'm talking about here? Can you guys see that pattern of things? Good deal. All right. So yeah, this is what we call analytics. So we're analyzing these things. Now, inside of these meetings, when we have them, these sessions that we do on Mondays, my intention is to make sure that you have like these type of skill sets, like the knowledge base to make these decisions, like plan, and be clear at it. You go into things. Otherwise, we could just go based off our feelings about it. And feelings are horrible masters. They're horrible masters. Right? You want to actually have something to fall back on. And you want to fall back on the patterns of life. Like what can I rely on in terms of patterns? This is how you analyze information. Okay.
Cheston, did you see the question in the chat? They want to know, can you define the spot market?
Yeah, I did go back and talk about what spot market was. Now, Ron, did you get that? Was that clear when I went back over it? Like the broker rates? Was that good? Yes, all right, fantastic.
Yes.
All right. Good deal. Okay. Now we're going to get into it. This is really what the conversation is about today. All that was like review. Okay. Well, here's some statistics for you. And I'm talking about having the skill sets necessary to make strong decisions for your company. That's what it's really going to take in order to weather whatever storms are here right now inside of the economy. It's going to take these types of skill sets to be able to understand how to read the numbers and then have good practices in order to have the reality in front of you. But a lot of us don't have the reality in front of us because we don't do the things. We don't have the processes. We don't have the systems to track and record things in a way that delivers a complete reality. It says 21% of small business owners admit to not knowing enough about bookkeeping. I remember being a young entrepreneur. I got out of school. I went to school originally for applied computer science. And then I never did anything with that. Like right out of school, I started a cleaning service eons ago. And realized that I didn't know anything about business. But I really didn't realize I didn't know anything about business. That's the thing. I really didn't realize I didn't know anything about business. I thought I didn't know how to do the hard work and the grind and everything. And there were certain things like marketing, sales. I could sell a little bit. You know I could upsell some services to people inside of what they were doing. I could show them a value and pitch that. And I know I could do a pretty good job when it was time to do the service. But marketing, man, getting more business in the door, that was something I didn't have a real good skill set with. And then I thought I had that idea about numbers. I was always good with numbers. But I didn't have like the background that I really wanted to have inside of financial literacy when it came to financial statements and what they mean. And then, the KPIs inside of that, right? Or whatever the processes were to track and record that for my business. I remember I went to H&R Block. I remember it's like, man, it was like in 2000 or something like that, or like 2000, 2001. Long time ago now, right? I went to H&R Block to do taxes. And I had I was like the stereotype. I had a shoebox with receipts in it. And I took my shoebox with receipts down to H&R Block. And I was proud. I was proud of my shoebox. I thought, yeah, I'm tracking my business. Right. I took that shoebox down to H&R Block. Proudly put it on the desk and said, here, do my taxes. He looked at me like I was crazy. Yeah, like I didn't know, like who are you, man, bringing this whole shoebox full of receipts? They gladly took it and just placed it to the side and just disregarded my shoebox. They asked me about other things, right? And there I knew I felt a little bit embarrassed after that. And then I started, as I went on into business, I started really learning and understanding more and more along the way about what it takes to really get the full benefit of this business, this entrepreneurship life, right? At that time, I was actually reading a lot. Robert Kiyosaki was one of my favorite authors at that time. And another one was Charles Gibbons. Yeah, Charles Gibbons, I believe this is that author. So Robert Kiyosaki had his book, Rich Dad, Poor Dad. Like, I know you guys have heard of Rich Dad, Poor Dad, correct? Anybody not hear of Rich Dad, Poor Dad? Anybody not? Yeah, so he had that whole series of books. He talked about, assets and liabilities, and it wasn't a typical thing up until that point. But I didn't know it wasn't typical, but it made sense to me the way he was explaining it. Assets put money in your pocket, and liabilities take money out. It's a simplistic format of it. I didn't have the formal background in business that I do today. And I was setting off to kind of follow the philosophies of that, to make sure I get to keep more of my money. Charles S. Gibbons wrote a book called Wealth Without Risk. And inside that book, he talked about tax-free wealth. I mean, that put me on that path of discovery for what tax-free wealth looks like, and applying those things. So I went out as a young entrepreneur, thinking I was doing a job, and I really wasn't. I didn't know the skill sets. It's like we go to these resources and get this information, and it sounds good. Right? It sounds really good. The problem is application. Like, how do you really go out here and use this information? What do you do on a day-to-day basis in order to make sure that you're going to get the result? Not necessarily that straightforward, right? Like, the books get you excited, but then when it comes down to execution, what is it that you execute on? Right? There's so many technicalities in this that you want to know, right? So 21% of small business owners admit to not knowing enough about bookkeeping. And I see it. We do bookkeeping over here. And I see people that have, some people in their business, they have business backgrounds, they have accounting backgrounds, and they still don't know. They still don't know how to apply this stuff, right? I have people on my team. Well, we train every day on certain things. People who have PhDs in finance and accounting, and they still don't have like a workable, common sense approach to this thing. And it's not a business. Because how do you actually do this? How do you track these things? How do you classify things? You have real questions out here as a business owner, right? And then 21% say, I don't know enough about it. But then look at the next thing. 72% of self-employed contractors do their bookkeeping and accounting errands without professional help. What? most people do it without professional help. And then 70% don't have an accountant. 60% of small businesses feel like they aren't knowledgeable when it comes to accounting. Look at all this, man. And then 64.4% of businesses use accounting software, which is fantastic. And then we talk about outsource of tax preparation. The key things we want to focus on here is like really how we track and monitor our business. The skill sets necessary to do this, it is worth developing these. It's worth knowing these things, is what I want to say. And how does one begin to develop this? Well, I started accumulating this knowledge in 2020, ferociously, with such veracity. Is that what I want to say? Ferociously, with veracity. That is it. All right, I started accumulating this knowledge inside of this field because I understood the importance of the language of business, which is numbers. And then everything else we do, our other skill sets we bring to the table, like all of our talents inside of our what we do, like service wide, marketing wise, sales wise. Those are great. Like even like they're really important. But it will all go to the wayside. We'll lose it all. We'll actually do a whole lot of work and not get enough for it if we don't have this. That is the importance of it. Okay, so you want to hone in on this skill set. If you don't have the skill set, you want to reach out to the people who do. Partners who do it, people who care enough to do it the right way, and at least communicate the levels at which there is a gap in what needs to be done in order to bridge that gap inside of your tracking and recording processes. Okay. And hopefully that makes sense. You want to know this stuff, you want to actually execute on this so you can keep more of your hard-earned money. Yeah, I didn't keep my hard-earned money when I went to HR Block through our receipt box. I was mad. I was expecting to keep my money. They threw my receipt box inside, right? But that's what happens because you bring a shoebox of receipts. All right. So tracking and recording. What do we want to track and record? At this stage of the game, we talked about top line stuff last week. And when I say top line stuff, this is something that you want to hone in on because I'm using the terminology here. It's top line. That's like what we bring in. We call it top line because revenue is the first thing we look at on a profit and loss statement. Top line. Sales, like what comes in, what money comes in. Top line. Associated all these top line items are cost of revenue, like things that we had to incur in order to produce that revenue. Like we talked about variable cost, direct costs is what we call that to produce the revenue. So all this is related to the top line. But as we go through the whole financial statement for like a profit and loss, and we're specifically talking about a profit and loss statement, we talk about top line. We'll go through the rest of that. We have our expenses, and at the bottom line, we have, this is why people call it the bottom line, is net profit. What does it all mean at the end of the day? The bottom line, what's the bottom line? What do we get to keep is a net profit. Okay. So this is a world. We took a look at a profit and loss statement. This is a world of performance. How does my business perform? Right? The numbers will never lie. We actually look at the numbers. We can talk ourselves up. We can get and say what we want about how we did. We say, man, I did fantastic. I was killing my business last month. I was rocking it. But the bottom line says you were negative. Right? That doesn't lie. If you're negative in the bottom line, well, you didn't do fantastic. Right? According to performance. That's what we call a black and white. This is what we want to operate by. We want to operate by a black and white. Did we do the job? Yes or no? Right. Performance-wise, profitability is important. It's key. We want to know that we're making profits. Okay. And the higher the profit, the better the performance. Really simple, straightforward. Now, this is a whole world of performance inside of our profit and loss statement. But it really translates to money that we get to keep, money that we get to put in our pocket. So there's cash flow. Okay, I want to start talking about cash flow. No, the screen's not frozen. You might have saw that. Can you see the cash flow now? Yeah. Let me know. Yeah. So it's not frozen. We're just talking about, the background about what is impacting our cash flow now. We're going to talk about cash flow, and profit and loss impact cash flow. But we want to understand how. So ideally, in a perfect world, last month my cash was this, and this month my cash is this plus more. Positive cash flow. That is what we want. In order to achieve that, we want to understand clearly what impacts cash flow. If I can understand what impacts cash flow, I can make choices to direct that cash flow into a positive direction. Hopefully that makes sense. Now, there are three components of cash flow. Number one is operating, cash flow from operating. This is our world of performance that we were just talking about. Cash flow from operating. This is at the end of the day, did we actually make money this month? Yes or no? Were we in the black or were we in the red? Yes or no? Right. That's first and foremost. Did we actually make money? That's part of operating cash flow, positive income. So yeah, we have to drive profits. We have to make some money at the end of the day. And then we have to look at the efficiency of management of operating to see how we did with cash flow really. Because there are some things like accounts receivable, accounts payable, that actually impact cash flow outside of just our profitability. For example, you go and drop a load off, and typically, the customer wants to pay in 30 days or 45 days or 60 days. That's typically what they want to do, right? So if I do a load today, I'm not getting paid today for that load in like a standard way, right? That actually impacts my cash flow in a negative way. So I do a load for $5,000 that we drop off today, and I'm not getting paid in that load until 30 days from now. Well, that's a negative impact on my cash flow. That takes me down $5,000. Conversely, actually, before I move on to that, I want to make sure that we land this and drive this in. Okay. I drop a load off today. I don't get paid today for that load. I get paid 30 to 45 days later. The load was $5,000. Even though I might seem as though I'm profitable, I was profitable this month. That one thing, that one action that I took to drop this load off caused my cash flow to go down negative $5,000. Okay. Now, if we can understand this, we can navigate it, right, clearly. Conversely, if I have an accounts payable, let's say I have things that I don't pay right away, vendors that allow me to pay 30 days later on certain things, like let's say I have most fuel cards, they want you to pay every week, or at least as you go, depending on how that's going, right? But let's say I have a vendor relationship for maintenance that I was able to get. They say, hey, look, man, we can put you on a net 30 account. You don't have to pay us right away. Look at that. I got a maintenance vendor. That's impossible to find. That's when some maintenance person is gonna actually let me pay 30 days later for the job they do today. But in this magical world, let's say that happens. Okay. And that has a positive impact to your cash flow. Let's say that you had to get your let's say you got to get a radiator replaced. It was costing you like $3,000 to replace a radiator. Right? That's a positive impact of cash flow of $3,000. So we take a look at that, like what we just did. Let's say that all this happened like within the last 24 hours. So you had the load that you dropped off. They're not paying you that $5,000. So that's minus $5,000. Look at my beautiful handwriting, people. Oh, the dollar symbol. Oh, negative 5,000. All right. And now that's cash flow. And if I have a vendor that says, okay, you can pay me later for this job, $3,000. Well, that's positive. 3,000. Right now, with just these two things, my cash flow from operating is minus $2,000. This is the effect. This is the impact. Okay, this is something that I don't know if a whole lot of business owners are aware to that degree of what cash flow is doing. Now, there's an automatic response to situations like this. Everybody knows that they drop off loads. If they have a customer that doesn't pay for 30 days, a lot of times the solution that we'll look for is factoring. Because factoring or quick pay, right? Factoring or quick pay. Some these customers that do quick pay. It's okay if those costs are relatively low, but if they're higher costs, then it's like, wow, man, it's eating into your profitability. Long term, that has negative consequences. right? If I'm paying 3% for factoring, and my company is generating $1 million, well, that's 30 grand a year on a factoring, when I could just wait for my money and have an extra 30 grand in that year. I can increase my profit, but like for a lot of people, 30 grand extra is a good amount of money extra to have in your pocket, right? So those are the things that we want to think about when we're making these on the moment decisions. Yeah, it may give you money today, but it doesn't change the fact, like it still has this is still going on in the background. There's still a negative $5,000 impact to cash flow from that invoice. It's just that you circumvented it by getting an extra injection of of 48.50 for that load. That's 3%, right? So that's the impact of it. Now, on the backside of this, I'm gonna start bringing this home with some cash flow concepts. I really want to get you guys to understand like what it is that we do each moment. We're not really thinking about it. It has systemic impact to what our operations, the health of our operations, rather. On the other side of this, like we get that cash injection from the factoring company of 4,800, really 48.50, and that takes us up. That takes us up, positive. So now we're at 2,850. And we're like, yeah, we're in the positive cash flow watch for operating. But down the line, when you're expecting to get this positive impact of cash flow from this vendor that was going to pay in 30 days, there's also this negative impact of 5,000 to the factoring company later on in 30 days. And you just kind of trade it off for a lot less, or a good percentage less. All right? Does that make sense? All right. So other things that impact operating, cash flow from operating, things like lines of credit, fuel cards. Like these are the things that we want to use in order to manage our cash flow. And fuel cards are probably one of the better things that we can do in order to have that cash flow managed, because they don't really cost us much. Like they actually save us more. They actually improve cash flow all the way around with the right fuel card. Some of these fuel cards you get is like 40 cents off the gallon, 60 cents off the gallon, 70 cents off the gallon. I've seen that too. Right, so that's a real good impact on cash flow. So if you're looking to manage your operations, these are the things you want to focus on. Lines of credit that don't really charge much interest on them. These could be like really great for cash flow injection, for operating cash flow anyway. And of course, making sure your sales are up there. You always want to have high sales, high revenue coming in. Look at all the ways that you can to execute on performance. Right? If you can get an extra load in, whereas you wouldn't otherwise, to get that extra load in, it improves cash flow. The other things that impact cash flow, we're going to move on from operating. All right, there's a whole world of stuff that we can talk about inside of operating, and we'll actually have that conversation at another time, a full call on that. But there's also cash flow from investing. What is cash flow from investing? Anybody know what this is? What does it mean to have cash flow from investing? Well, actually, give an example of this. Give me an example of cash flow from investing. Anybody write that in the chat or just shout it out? Who has an idea?
Getting a return on the money you put in.
Okay, I got it. Well, that's a little ambiguous though, Baxter. Thank you for that. And that's a little ambiguous, right? Your whole business is an investment. If we didn't know that, right? The whole business is an investment. We expect some type of return from the investment of our business. But if we're thinking about cash flow from investing, especially inside of trucking, trucking is what we call an asset base. Like if you have a trucking company, you're an asset-based company. Right? So what it means to be an asset-based company means that you actually have equipment that you purchase. You have to have that equipment in order to do your job. If you didn't have the equipment, then you would not be able to do that job. Right? So that's why it's asset-based. So what type of equipment? You got a tractor, you got a trailer, got maybe dry van, maybe flatbed, maybe low boy, maybe you have a box truck, whatever it is. There's equipment that you purchase. All right. So when we actually transact that, we make those transactions, there's an impact to cash flow from investing. Right. So if I take cash and put it into a piece of equipment, well, that's a negative impact to cash. Right. See, these are the things that impact cash flow. Now, if I understand this, like if I'm thinking along these lines, then it won't just be me buying any piece of equipment just randomly anytime. I'll actually understand how it's impacted my cash flow, and I'll know when I'm ready for purchasing a new piece of equipment. Yeah, that's a good point to bring up, Ron, about investing in a mechanic. And it's not necessarily this, right? So if we're looking at it from a financial perspective inside of like what we call your financial statements and understanding the business side of it, like cash flow from investing really does concern like buying and selling off assets in your business. And when we're looking at assets in this business, it's really the equipment that we purchase to do the job, whether it's going to be a truck, a trailer, box truck, or whatever it is. Those are our assets. We take our money, we put it into this equipment, and cash goes down as a consequence, or we sell off this equipment and cash goes up in the reverse relationship. Okay. So if I actually understand these concepts, I could be more strategic in my approach to managing my cash flow. To talk about, there's a term called liquidity. Like how liquid is a company? As you hear a lot of people say, if they're not very liquid, then there's a high risk there for a lot of companies. So liquidity just means that I have cash on hand, cash or cash equivalents. Cash equivalents are things that can be easily converted into cash very quickly, right? So if I have a lot of liquidity, that means I have a lot of cash on hand available to do things with. Now, if I'm not liquid, that means, and I have if my balance sheet shows I have a lot of worth, but I'm not really liquid, well, that just means I'm very asset heavy. I have a lot of things that are not cash, but I can't really use, I can't spend, right? And if I get in a bind to pay for some stuff, I'm gonna be stuck because I don't have enough cash on hand to do it. And this is why cash flow is so important. It is the lifeblood of your business. And if you don't have the systems and structures in place, and also the understanding in place to manage your cash flow, then you're not set up for wins inside of your business, to be straight, okay? But this is cash flow from investing. When I purchase assets and I sell off assets, that has an impact on cash. Purchasing makes my cash go down. It's common sense now, right? It makes sense. It makes sense now. And if I purchase assets, my cash goes down. If I sell off assets, my cash goes up. Okay. Now, the other thing that we're looking at inside of this is cash flow from financing. Now, this side, another pop quiz. Cash flow from financing. What is financing inside a business? Cash flow from financing. Give me some examples of that.
Cash flow from financing.
Yes, pop quiz. Go.
Hey, you go out there and rent or lease something, because you got a $500,000 contract. You lease whatever for $4,000 a month. There it is.
There you go. That's good. That's an example of financing, right? It's not the entire body of it though, right? That's part of it. Two ways to finance a company. Thank you, Baxter. That was good. Anybody know the other side of that? I think as far as What Baxter just talked about is going out to sources and getting like a lease or a loan. Lines of credit, good. Lines of credit are more so on the lines of operating because these things are due, like lines of credit are short term, like really short term. They're revolving and you pay them off quickly. So it's more so in the lines of operating, cash flow from operating. Okay, but that was good call outs. That could be confusing. Okay.
What if I were to buy a house that I had planned on renting out or using, and whatever my monthly payment was less than what the money that the property accrued monthly? So would that be cash flow financing?
Not entirely. That's good. There's a few components to that, right? There's all components inside of that. We can look at them distinctly. Okay. There's cash flow from operating because now you have money coming in for rents, right? So that's operating. And then you have your expenses that go out, that's part of operating. And then you have a net profit, that's operating. Then you have cash flow from investing, right? So we actually purchased the asset, we actually bought something, we invested in the property, right? So the cash went down because of that. But then we also have cash flow from financing because there's a certain portion that we had to borrow, right?
That's the Walmart model.
The Walmart model, yeah.
No, I mean, as far as how they never really pay for anything. You know, they put all the inventory on credit, and before the bill is due, they're pushing it out the door of the stores.
Well, that model right there, that's not like that's a line of credit. Like if you have a line of credit for that, that's good. That's really good to look at. So if you look at these models, like for companies like a Walmart, like another companies that are publicly traded, Fortune 100 companies, this is like what they do. They look for ways to really be efficient with cash flow management. So that's it. Like this short-term lines of credit, like 30 days or whatever, I'm not paying any money on it, but I'm not using my cash up front. I keep my money and then I wait to get paid on everything that I'm owed. And now I'm just improving cash flow every single month because I have this strategy in place. Right. And this could be you, right? If you actually understand how that works and you're focused on the right things inside of the trucking business. And this is why we're having that conversation, is because we want to be in that line of thinking. Okay. So fantastic for bringing that up. But we want to be clear on like where these things are distinct from one another. Okay. So the financing aspect of it is when I borrow money, like loans, like long-term loans. Yeah, so that's a positive impact to cash. I increase my cash because I borrow money from a lender, right? And I'm also increasing cash in my business from capital injection, equity. Two components of that. All right, so we have loans and we have owner equity. Owner equity means the money that the owner puts into that company out of their own pocket. All right, so that actually capitalizes the business, it finances the business. Right now, it does not necessarily be one owner. This is why companies go public, is because they can finance it through shareholder equity. You know, they have a certain amount of shares at par value. They go public. You know, an OTR, and now they have, you know, all of a sudden they have all this money because they've been able to get shareholder equity through financing this. So that is another example of positive cash flow through financing. Right? Two components of that. We have loans and we have equity, debt and equity, in order to finance our business. All right. So with that being said, I don't want to overload you with too much more tonight. This is a pretty heavy and technical conversation to be inside of, but there's power inside of this conversation if we get it. If we get like cash flow, because it is the lifeblood of your business, and we're bringing this to the table because it's going to be your understanding and execution on cash flow that gets you to the other side of whatever market you're in. If you understand this, and if you look at these components of your business, now here's what I see. A lot, because of those statistics about business owners who really don't understand how to track and monitor and record and do bookkeeping for their business, there's no reality. They don't know. You can't see it. So even if you're recording it to some degree and you don't have like the technical skill set, if you're like missing stuff, then that might be, I won't say it's worse, but it's like, it's painful because now you're basing your decisions on something that's a lie. Right? You think you're doing something and then it's not the truth. It's a lie because you didn't really record things properly. You missed some things, right? So you do want to have that skill set involved with your bookkeeping and recording so that you have the truth in front of you and understand how your company is performing without a cash flow, right? Whether it's going to be from operating, investing, and financing, you want to understand the components of that and see how you did and really hone in on that and be strategic. And hopefully that makes sense, guys. With that being said, I was going to open it up, like questions, comments about what we've talked about tonight. There was some really good information here about where to be inside the cash flow. I want to make sure that you guys take away from here some next level action that's going to help you improve this inside of your own business. Anybody have questions? Comments?
Other than you just made my head hurt. But no, my question is back to the factoring piece. How would you consult a customer or a trucking company customer when it's time, when they're ready, or when their business is healthy enough to not have to worry about factoring or to stop factoring their invoices?
Yeah, so there's a plan in effect. You're going to get to a certain reserve amount and you can quit it. The reserve amount is going to be in 6 months operating. You get to 6 months operating, you don't need factoring. Reserve. You go execute on that, you put money away, you stack money away, you have 6 months reserve, well, you don't need factoring. All right, collect all your invoice 30 days later. Wait for it. You can incentivize your own customers for paying quick. You can, if you want to do that, you can do like a 1% discount, something like that on quick pay or whatever you want for your customers to pay quicker. But outside of that, why give money away? Plan and get a reserve.
Absolutely. 6 months.
Yeah.
That's the plus. Okay. Thank you.
Yep. I would even say that if you have, even if you have 50,000 in revenue, you want to start being in the conversation of having somebody to do your bookkeeping, or at least have a consultation. Like if you're not comfortable paying, like it'll be about six grand, somewhere around 6 grand a year for a good bookkeeper. Okay, somebody who knows what they're doing. Somewhere between $4,000 and $6,000. Sometimes more if your company is like actually doing a lot of volume. If you're have a lot of accounts receivables and a lot of accounts payable, then it's going to be more. But if you're starting out and you're under $1 million in revenue, somewhere around 4 to 6 grand is where you're going to be. And you have to think about whether or not it's worth it. Some people really hate doing the administrative task of bookkeeping. Some people hate it with passion, right? And because that's in the way, it causes us not to really be good at that skill set. And then a lot gets left on the table. I was on the phone today with somebody who just doesn't do that, hasn't done it really properly. And then they filed their taxes with somebody and, they're leaving like thousands and thousands of dollars on the line, like more so than they would pay a bookkeeper. And they're not doing that much in volume and revenue, right? So you want to make sure that you start being in that conversation sooner than later, is what I want to say. 50,000 in revenue, start looking out there for somebody to help and give you some guidance. If you don't know what you're doing. Good question. All right, guys, I mean, it's 8 o'clock. Is there anything else? We have one more question before we wrap up, but it's 8:01. If not, we can wrap this thing up. That's it.
Appreciate you coming on tonight. man.
Yes, sir. All
Thank
right,
you
guys.
very
it's been
much.
Great being with you.
Good information.
Great, great, fantastic. Glad you got some value tonight. All right, so I will see you all next week. Have a great week until then. Take care.
You too. Thanks.
Have a great one, you all.